Hello, my name is Joe Hoyle, and I'm speaking to you from the University of Richmond. You have now read Chapter 14. And I believe that Chapter 14, at least in my mind, is the most complicated chapter we have covered so far. Now clearly, all of the chapters have difficult material, but I think that Chapter 14 was both some of the most interesting and complicated material that we have had so far. However, if you plan to be successful in the world of business, you need to know about debt financing. So therefore, although the material can be challenging, you need to learn what these terms mean and how the world actually works. So now that you have read Chapter 14, I hope you've taken time to write down your top 5 things in this chapter. And this was a difficult chapter to come up with the top 5. There were many things important. What did you think? Here, let's go and see what I believed. Here is my number 5. For me, number 5 was the concept of financial leverage. It's a term that you hear so often in the business world that I wanted to make sure that you knew what it meant. Financial leverage means that you use debt financing to make money to increase your own, as the owner, net income. For example, if you borrow $1 million at a 6% interest rate, then the cost of that bond is $60,000. But if you can use the $1 million to make more than $60,000, then you've increased your profitability without risking any of your own money. Many companies that are heavily debt financed use this leveraging to increase their net income. And remember, the interest expense is tax deductible. So even if you pay $60,000, your cost is actually less than that because you reduce your income taxes. But if you can make a profit that's larger than the cost of the money that you buy, your profit increases based on using someone else's money. That's a concept that's widely used in the business world, and it's a concept that I want you to understand. Let's go now to number 4. For me in this chapter, the 4th most important thing was the discussion of all of the different types of bonds. Companies need to raise money. Companies need often to raise a lot of money. Therefore, officials that own or operate companies need to know how bond market works. We discussed here 3 different types of bonds. Zero coupon bonds that have a payment at the end but no interest. Term bonds that pay interest all along and then pay the principal at the very end, and serial bonds that pay both interest and principal each period. Most companies use some mix of all 3 of these, but clearly some of them are more popular for companies than others. But I need for you to understand what these terms mean. If you look, for example, at the Wall Street Journal, and a company mentions a zero coupon bond, or a term bond, or a serial bond, I need for you to understand what that term means. That's what it means to be a well-educated business person, to understand what the terminology means. So for me, in this chapter, the 4th most important thing was simply the types of bonds that were introduced to you. For me, in this chapter, number 3, as far as importance, was the computation of interest expense. When you create an income statement, you recognize interest expense. It is the cost of the debt that you have outstanding. How is that interest expense determined? We showed you here in this chapter that you take the book value of the debt, which is the principal, and you multiply that book value, that principal, times the effective interest rate, which we also called the yield rate or the negotiated rate. That determines the number that you show on an income statement for interest expense. That's the number that we use to report this cost of this debt. Since debt financing is so important, I felt that determining the related interest was also important, and I placed that number 3 when I reported, or when I set up my list of the 5 most important things in this chapter. On your list, what was number 2? For me, the term compounding was number 2. You hear the word compounding often in television ads and in newspaper articles discussing financing. The word compounding is used a lot. Therefore, I really want you to understand what the word compounding means. Periodically, you will compute interest expense, as we did earlier in this video, the principal of the debt times the effective rate. However, often the amount that's actually paid is different. This is especially true when you have bonds, where the cash rate is different than what the negotiated rate was. So if, for example, you have interest expense that exceeds the amount of cash that is paid, the excess amount is added to the principal. If you recognize interest but do not pay it, that amount, that excess amount, is added to the principal. The idea of adding the amount to the principal is compounding. So if you have a bond, for example a zero coupon bond that does not pay interest, and you recognize interest but do not pay it, then that excess amount is added to the principal, making it larger, of course, and that process is referred to as compounding. And now, let's move to number 1. Companies must raise large amounts of money. Therefore, companies issue huge amounts of bonds, hundreds of millions of dollars of bonds. I wanted you to understand how the bond market worked. I wanted you to understand how the two parties price a bond. They first come up with a negotiated interest rate. They will discuss and come up with what each party is willing to accept as an interest rate. That interest rate then is applied to the cash set up in the bond contract to determine the price. That is done by a present value computation. We discussed this a little earlier in intangible assets, but we look at it very seriously here in chapter 14. We take the future cash flows as established in the bond contract. We then determine a reasonable amount of interest based upon 3 variables: the negotiated interest rate, the number of time periods, and the cash pattern. And the cash pattern could either be a single amount or an annuity. And an annuity is an equal cash payment at equal time intervals. We use those 3 variables and the present value computation. And you can do the present value computation using a table, by using a spreadsheet, or by using a formula. The textbook talks about this. What that does is it takes the future cash flows and it removes a reasonable amount of interest. So the number that you have left is the present value. The number you have left is the price of the bond. The number you have left is the principal today of those future cash flows. That is how the amount is determined by the parties involved in a bond transaction. For a business person, that's very important information, and I really thought it deserved in this chapter to be the most important thing that we covered. Your list may be different than mine, and that's perfectly fine. Your teacher, your friends may have had different items. The idea is to figure out what you believe was the most important. There were many things in this chapter that any person who wants to be successful in the business world should know. These were my top 5.